You're listening to the Digital Deep Dive, where we tackle the newest trends, strategies, and pain points shaping growth across the digital landscape. From Amazon and D2C to international expansion, join our host and e-commerce leaders across multiple industries for in-depth discussions on how to maximize your brands in the digital arena. Now, here's your host, Aaron Conant.
Well, hello, everybody, and welcome back to the Digital Deep Dive podcast. I'm your host, Aaron Conant, and back is a great friend, James Thompson, former Amazon agency, former DJ even. In this episode is going to be focused around the aggregator space. Had a lot of brands reaching out, wondering what's going on in the space in the here and now. And to tackle that, I think we actually have to look back a couple years and then where did it start? How did it originate? What took place during the pandemic and tons of money flowing around? And then where are we at today? And so James spent a lot of time in this space doing a lot of research around it as a whole, and just agreed to jump on and have a cool conversation. James, I'll kind of kick it over to you if you want to do that brief intro on yourself. If you want to throw in the DJ gig, I thought that was pretty cool.
Thank you, Aaron. Delighted to be back. I've had the good fortune of working either at Amazon or with brands on their Amazon channel efforts now for about 15 years. And I've seen all sorts of crazy stuff happen, but I haven't seen quite so much crazy stuff as what I'm seeing with the aggregator space. Billions of dollars flowing in, excitement around private label brands on Amazon. It's not all exciting in positive ways. And, our conversation today will focus on how did we get to this point and what do CPG brands do now that the market's changing and there's opportunity potentially to do some disciplined, acquisitions. So looking forward to our conversation.
Yeah, it's going to be fun. So, you and I have been talking about this space since it kind of caught fire a few years ago. Would love your thoughts on where it started, why it started, and then we'll kind of walk through, the past couple years as tons of money has been flowing into it. And it's almost, I don't want to say unregulated money, but, there were no reins put on at the time and then where we ended up. So take us back a couple years, how you see it all kind of form.
Well, I'm going to go back to, the 10 years, 12 years ago, when I was at Amazon, there were these things called private label sellers, and they were a fairly new breed of seller, people who were going and building their own brands, sourcing stuff often from overseas. That was kind of a weird and wonderful way for sellers to not have to compete head to head on the same listings. They could build their own brand, be the only seller, and life was grand as long as you could drive traffic to your listings. But it took a number of years for traditional banks to recognize that these were actual businesses that spat out legitimate cash flow on a regular basis. I mean, I remember many of my third-party seller clients, they couldn't get a bank loan from a traditional bank because banks just looked at this and said, well, that's just this weird e-commerce thing. We don't really understand it. It doesn't make sense to us. At one point, Amazon actually was the primary lender to many of these sellers because nobody else would lend them money. When you look at traditional large investors, private equity, venture capital, they were not the ones who were looking at Amazon as a big opportunity until, some of the traditional banks started to recognize that they could actually lend money in a risk mitigated manner to some of these sellers. There were a few pre-aggregator type companies that tried to buy up some firms. The well-known ones was a company called 101 Commerce. They were going to buy 101 private label brands, put them together, create efficiencies, and be in a position to create a really strong financial investment. It didn't work out that way, but 3 or 4 years later, the big first entrant that we all know about is this company called Thrasio, and they were able to raise some capital, start buying up some of these private label brands that look like good businesses. But as people started to pay attention to what Thrasio was doing, lots of other people said, I think we can do the same thing. And so you ended up with a number of M&A folks who rushed out, managed to raise $100 million here, $100 million there. And soon $10 billion have been raised across over 100 of these aggregator organizations. And they were all fighting to buy up these private label brands. For entrepreneurs who were running these private label brands, this is a very exciting time. All of a sudden, everybody wants to dance with you. And in the past, nobody wanted to dance with you. And now people are saying, your brand's amazing. We want to buy this because we see it as a growth opportunity. We've got bigger checkbook than you do. And so not only will we buy your business, we're going to continue to invest in your business in ways that you couldn't do as a 1 or 2 person entrepreneur firm. So, on paper, this all sounds theoretically great, but it requires a couple of really, really important skills for the aggregator to succeed. The first skill is you've got to have M&A people who are very disciplined about what they buy. And number two, once they buy those assets and turn them over to the operational team within the aggregator, the operational teams need to know exactly what they're doing around what it takes to manage and grow an Amazon business. As we've seen in the last couple of years, the discipline that went into acquiring these firms often wasn't what it needed to be. And so companies were acquired for multiples that were unreasonably high for anyone to be able to make money on these brands anytime soon. And when those brands were then purchased and turned over to the operations team, often these aggregators didn't have the right types of skills or enough of the right types of skills in place to be able to take on those businesses and continue to run with them. Think of it this way. You buy a brand from me that's an Amazon brand. Amazon doesn't have a sandbox. You can't like go time out, hang on, I'm trying to learn how to run this business. You buy a brand. On day one, you're running the brand. On day one, you have to understand all the rules and policies of Amazon. Think of it as trying to change the pilot mid-flight on an aircraft. You can't easily do that unless you've got a really strong operational team in place. I used to run an Amazon agency with my business partner, and we had a lot of employees who were poached by aggregators who were promising huge salaries to some of these folks. And they would go in, and there were no standard operating procedures in place. We were kind of, figuring it out as we go. How do we take on all these portfolio companies and do something with them? Now, I'm making some generalities here. There are some aggregators that got their act together a little bit better than others. But all in all, the two primary challenges go back to, do you have disciplined M&A, and do you have top-notch operational capabilities in place to be able to take on these newly acquired portfolio companies and figure out how to actually create the growth that you're telling your investors you can get?
Yeah. So, if we think about the original business model, it wasn't necessarily a flawed business model, right?
Not at all.
I'm going to buy this company. I'm going to get economies of scale. I can get rid of, their advertising teams because I have one, finance teams. I can take this, plug it into my team. And then all of a sudden in some cases, I can actually, pay a higher multiple potentially.
Yep.
Because I'm basing it on an EBITDA that's going to be bigger when I shed all this extra stuff that I already have. But then
that is the theory. Yeah. That's the theory. And the other way that these companies were going to make money is if they buy a bunch of companies and roll them together and end up with top line revenue that's a much, much larger number than what any one of those portfolio companies alone might have been able to generate. If you own a $5 million company, and then I over here at the aggregator, I own 100 $5 million companies, by way of the company being that much bigger, you're going to attract new classes of investors who would potentially be interested in buying or further investing in the aggregator versus the number of companies that are going to buy a $5 million brand in the first place. So there is some of that financial instrumentation that should work if you're able to continue to create businesses that are just as profitable, if not more profitable, and have some sort of organic growth component to their bottom line. So either way, whether it's doing the financial instrumentation or the operational skills to grow the business, either way, you need to be good at those things, and you need to have not only a plan in place on day one, you actually have to have the right teams and the right standard operating procedures in place on day one, because it's live the moment you acquire a brand.
Yeah, no, it makes sense. And I think the other thing that happened, like you're talking about during the pandemic, even the price tag on anybody who really understood digital and understood Amazon on that person and that value went through the roof, right? That's just, if you knew Amazon and you really knew it well, like they were coming around and poaching, but they couldn't poach you at a 25% premium. They're poaching you at a 50, a 75, 100% premium.
Yep. Plus offering you equity. Well, what possibly, doesn't look great about that? So you've got, let's say dozens of these aggregators all at once that have raised all this capital. They need to put the capital to work, which means every time a new private label brand comes up for sale, there's an awful lot of organizations at the trough having a look. And when you have much more demand for brands than there might necessarily be supply, inevitably the price goes up on some of these portfolio companies. That's great for the private label entrepreneur who's in a position to sell his or her business for a much higher multiple than they expected. And I'm going to make $5-6 million by selling my brand that I've been running myself for 7 years. And now all of a sudden someone's telling me it's worth a crazy amount of money. Sure, good time for me to sell. The problem is just because the multiples go up and the entrepreneur gets paid doesn't necessarily mean that the asset is all of a sudden that much better an asset. In fact, I talked with one banker who participated in a number of these deals, and he said to me that as he was going through selling these businesses to the aggregators, some of the aggregators were doing literally no due diligence. One company said to him, we'll close a deal even if problems are found because we need to put the money to use. Well, what's the point of doing due diligence if you find a brand really doesn't have the runway necessary to continue for the aggregator to grow it many times over? So that's what I'm talking about when we think about how do you make good decisions during the M&A process. There's an old saying in retail that you make your money when you buy product, not when you sell product. And if you're buying businesses that aren't the right businesses for your existing portfolio, are priced the wrong way, it's going to be very difficult for you to make money on them. On the other hand, if you're an aggregator that says, we have a very specific category strategy, we're only going to buy businesses in 2 or 3 categories, we're going to develop deep expertise in those categories, we're going to have multiple brands in those categories that allows us to do a better job with sourcing, better job with Amazon advertising keywords, a better job with understanding Amazon policies within those categories. It's much easier operationally to be in a position that you can actually create more organic growth than the next guy who just randomly buys that company and throws it into a portfolio of 20 or 30 categories of products.
So we're not at a point where it's still a good business model if it's run and operated the right way, because there's a lot of chatter out there. Hey, this is a model. It's gone. It's going to go back to just large, corporate, large companies as a whole going out and picking off, like a P&G or a Colgate or, one of these Fortune 500s that are going to go find the Kind bars and buy them.
Right.
This is still here. It's just not the feeding frenzy it was. That wasn't great business in the first place.
So let me clarify that comment, because there is some misperception about what's going on versus what certainly aggregators want us to believe is going on. It is true that aggregators as a whole are making far fewer purchases. But for a 2-year period, there were a number of companies who typically buy brands who were pushed out because of the increased demand from aggregators. Private equity, CPG, those types of organizations have been buying well-run brands. They've been buying them for a long time, not necessarily dozens of them at a time, but private equity and CPG do make deals buying brands for tens of millions of dollars a year each, but they couldn't afford to do that when the multiples went to 6, 7, 8 times EBITDA. That those numbers simply didn't make sense. Well, now that the aggregator demand has started to slow down, the private equity folks, the CPG folks are in a better position to approach the brokers and the bankers and say, let me see the deals you have. We're interested in doing 1 deal or 2 deals, but we're in a position that we want to buy good brands. We want to buy brands where we're going to do due diligence and look for problems. And if there's too many problems, we're going to walk away. In fact, one broker said to me that one of the trends that he's seeing is that on bigger deals today, it's much more common for a brand to have to go through multiple LOIs before they get a deal done. That is to say, multiple buyers will take different cracks at the brand. And once they go through and do the due diligence, they'll decide this brand is not right for me. I'm walking away and I'll let someone else decide whether they want to buy the brand. When you had aggregators at the table, if there's next to no due diligence happening, it's a mad feeding frenzy. You're just buying up whatever you can as quickly as you can because you need to put that capital to work. Well, it's just now a very different environment, but you do still have buyers at the table. They're just not disproportionately aggregator dollars that are being used. It's going to be traditional investment dollars that are being used.
Yeah. So it'll be interesting is, that pendulum swung way over to the aggregators. It's coming back to CBG, PE. Does it ever go back to the aggregators as they kind of clean house and get a little bit more strategic? That'll be interesting.
Let's talk about that for a minute. So if you look at a CPG firm today, one of the largest groups within large CPG is going to be new product development, product extensions, and folks that focus on different forms of organic growth. When you look at aggregators today, the teams that focus on that are small to non-existent in most cases. And so where is the organic growth going to come from? Well, it's supposed to come from, we know how to build better listings. We know how to put advertising to better use on Amazon so that we can generate more traffic on the existing selection we have when we bought the firms. It turns out for most products, especially on Amazon, where the half-life of products can be 18 months, you've got to continue to build new products, to refine the products you have, to be looking for ways to ultimately replace the selection you have today. If you don't have a team that is focused on that and really good at doing that, life becomes very difficult after you've owned these portfolio companies for a year or so and realize the buttons you're pushing to drive growth are not adequate. You need more buttons that focus on new selection, better selection, refinement of the selection you have, being able to rationalize the catalogs you have and say, you know what, 60% of this we actually don't need. Let's take the cash that we've been putting into this slow moving part of the catalog and focus it on other things like increasing the existing selection that is selling, plus developing new products, new lines of business, and so on and so forth.
It's not just like having the right people, it's also the right tool sets. And there's so many new tools that are out there that allow you to find out which products are moving, feedback from current customers. But there's one place I wanted to tell you this is you brought up Thrasio earlier. It was one of the first ones that was out there, really making some waves. They got a huge investment. And then at the end of last year, there were some layoffs and then some more that have hit. Kind of like the word on the street right now is like their M&A teams are like gone. What is, if you hear that, what is your interpretation of that as a whole?
Certainly Thrasio laid off a number of M&A folks. Whether every single one of them is gone, I can't comment. But a lot of folks are gone. I think it's important to understand, why do you need a good M&A team at an aggregator? Certainly you need a good M&A team to acquire good portfolio companies. But over the next 6 to 8 months, aggregators are going to need good M&A people for a completely different reason. As they are having to deal with being cash strapped, not being able to get new investment, having investors putting more pressure and more tension on the numbers, some of those aggregators are going to have to start to sell off parts of their business because they need the cash. And if you've got an asset, you've got a brand that may or may not be performing the way you want, but you need to find a way to sell that off to somebody else. Often the deals for those types of brands may be small enough that a broker or a banker doesn't really want to get involved. So you're going to need your M&A folks more than ever to step up and say, okay, how do we shine up this asset? How do we find other aggregators or other types of investors who are willing to take on this asset? And how do we actually do the transaction? It's probably going to be a private transaction between aggregators, between an aggregator that has cash and has knowledge on how to take that asset and actually drive organic growth. But you need your bankers to be able to help with some of that. If you don't have in-house bankers to do that, you're going to end up having to dump stuff to potentially smaller brokers brokers that do smaller deals. And that's not necessarily going to be the best way for these aggregators to get top dollar for some of the portfolio companies they're trying to sell off.
Yeah. So if the PE folks have been kind of pushed aside, right, in the CPG, have they been stockpiling cash? Is there the idea that they just waited it out and this money has just been piling up? And now for pennies on the dollar, they're going to be able to go get these.
So let's separate out two things you've said. Has the money been piling up? Well, 6 months ago, there seemed to be infinite amounts of capital available. Things have turned here in the last couple of months. Money's a lot more expensive. Those private equity investors, they didn't just sit around with money that they didn't spend. They were investing in other types of businesses. And so to the extent that there may be some money now available to invest, it doesn't mean that private equity is going to overinvest. No, private equity typically has been much more disciplined about buying companies anyways than what the aggregators on the most part demonstrated with their own behavior over the past 2 years. So you've got a situation where, yes, private equity might buy some of these assets, but private equity typically buys bigger assets, companies that are in the tens of millions of dollars, not these $3 and $5 million brands that a lot of aggregators decided to buy. The other thing to keep in mind is, even if you do acquire a brand that has lots of growth potential and is reasonably sized for whatever size investor you are, you still need good operational capabilities in place. Well, in most cases, the aggregators have done away with the entrepreneurs who started these companies. Those entrepreneurs got their earnouts and they left. And so whatever operational capabilities there are people within the aggregators. So the question to me, the big question for me is what would a private equity company do if they buy one of these assets, whether it's a problematic asset or whether it's an asset that's perfectly fine? They're going to need to bring in operational talent to be able to run those businesses. And when I say operational talent, let's be very specific about what I mean. We're talking people that understand the Amazon channel very well, people that may be skilled at helping brands to push their products into physical retail channels. One of the comments I got from one banker, he said that one of the brokers, one of the aggregators had decided to start looking at how to push their products into physical retail and hired somebody who has next to no experience with that particular skill to be in charge of that. Well, physical retail looks at lots of products every year. And if you're going to try to push your product into physical retail, you better have somebody who knows that space really well, knows exactly which products to be offering up to retail. And so getting the match of skills and getting the right people in place continues to be an issue for no matter who owns these private label brands. Because again, keep in mind, the guys and gals that started these businesses, they're long gone. They've been pushed out of the equation. And yes, you might be able to bring some of them back with some hefty paychecks, but that's not what these entrepreneurs typically, what they want to do. They want to start businesses, build them, and sell them. They don't want to have to come in and resurrect a business that is failing and may not necessarily be in a position to be resurrected.
Do you find that a lot of these businesses that sold, like, are they happy they did? Like, are you talking to them on that side as well? I mean, they got the cash they got out, but there's also, I think a lot of them potentially had earnouts based on what the growth was. If I'm handing it over, expecting, I'm going to take a chunk of my cash now and a chunk in a year and a half, 2 years based on growth, and they don't know how to run it, and it's not, operating as efficiently as they thought. By the way, there's a pandemic and supply chain issues.
Right.
I'm not getting the check I planned on. Have you seen that?
No, I've heard many anecdotes to that effect. It comes down to how was the deal set up in the first place? Did you get 60% up front and then, 40% a year from now? Well, that 40% might not look so attractive. The second bite of the apple isn't actually going to be as big, if not bigger, than the first bite of the apple. That certainly is the case. Supply chain issues are hard to blame on aggregators because, quite frankly, everybody has had that problem. Unfortunately, the entrepreneur gets caught up in it and suffers through not being able to realize the kind of profit on the sale that they expected. However, and I'm going to say something controversial, if that entrepreneur had continued to own the business for another year, he or she would likely have had the same supply chain issues as the aggregators. Even though the aggregators are supposed to have supply chain people in country overseas in a position to try to get priority supply, it turns out everybody was suffering through supply chain issues. That being said, you've got entrepreneurs who didn't get the money they wanted. They often have very strong skills for running these businesses, but they're not excited, as I mentioned, they're not excited to come back to try to rebuild the brand that they sold off. And so the question is, how many of these brands that were acquired by aggregators that now need to be sold, how many of them end up dying on the vine, or can they be resurrected? I think there's going to be an interesting secondary market opportunity here for very strong operators to pick and choose some of these assets and say, you know what, this one's underperforming, but we know exactly what needs to be done to fix it, and we think it's fixable. The patient isn't dead yet. We can bring this patient back to life. Figuring out how do you take the best operational people and put them on those types of projects. I think that's going to be the interesting development over the next 6 months. And by the way, you're going to have a lot of private equity dollars going in and investing in those types of operational folks because private equity has so much money to protect in its original investments in some of these aggregators.
Yeah, it'll be interesting to see how much they get back out at the end of the day. So what do you see as the next, 6 to 9 months here, the next year? What does the aggregator space hold for us? I know you highlighted a couple of things there, but I'd love to hear your thoughts.
So you have a number of the aggregators who have debt payments that are coming due. And when you have debt, you have to come up with cash, and the cash has to be available in time to make the debt payments. I have heard rumblings that several of the aggregators have not been able to make their debt payments on time. And some of the lenders have been willing to push back the payments a month or two to help these aggregators find more time to come up with the cash. But coming up with cash when you don't have any means being able to rationalize the portfolio companies you own, figuring out which ones to sell off, and then actually having bankers available to do the deals quickly to get the dollars you want. I suspect by Q1 next year, there will have been enough aggregators that have run into enough debt problems that they can't continue to push forward, that for some aggregators, the house will collapse very quickly because they can't get the cash fast enough to make the payments. The cash is called by the debt holder. And so these companies, unfortunately, may end up going belly up or having to sell off huge parts of, huge limbs of their business short term just to get cash. Well, if you start selling off enough of the diamonds in your portfolio, the chance of you being able to generate organic growth from what's left, it's a downward spiral situation. So I think there's opportunity here for CPG to pick over some of the portfolio companies. But quite frankly, it's not clear to me whether it's worth doing that, because a lot of these brands are still small enough that CPG probably wouldn't have bought many of them in the first place. If you're buying a $3 or $4 or $5 million brand that's now being priced at, let's say, 50 to 30% of that original number, is it worth CPG doing due diligence on a $1 million, $2 million brand? I don't know. Many CPG brands, if they've got an in-house banking team, they're wanting to do deals for tens of millions of dollars. And so it'll be interesting to see if we've got the right matching of size of brands with the types of brands that CPG wants to acquire.
And just even, I'm thinking back to what you're talking about earlier, is why the CPG, they've got the teams. Again, they've got the teams in the setup internally, as opposed to PE, who would go in and grab it and then has to set up a whole business unit. There's the flip side, which is, are you going to bring back some of these entrepreneurs who probably don't want to work for PE? That's why they sold and got out in the first place.
There will be some write-downs in the next 6 months. We're already seeing some of the aggregators writing down parts of their catalog. I talked earlier about, 40, 50, 60% of the catalog may not be selling enough volume to warrant any attention, whether it's advertising attention, supply chain attention, product listing optimization attention. Get those products out of here, and let's focus on doubling down on the selection that we know is selling and will continue to sell. But the problem is, again, that's short term. I know you have to survive short term to even think about long term, but if you're so focused on short term and you don't have the time or the capital to invest in new product development teams, product extension teams, and so on and so forth, it's not just the research team that has to figure out which products, but also the sourcing team that has to start having negotiations with suppliers overseas to build the blue version, the green version, the extra size version, whatever the extension might be. Those things all take time. And as we know with Amazon, when you have new products that need to be launched, if you are playing by the rules on Amazon, it takes several months for a new product to actually, grow legs and start to run fast enough to generate meaningful sales on the platform.
Love it. Awesome.
I do want to mention one other thing, Aaron. You asked, there's another development happening that is earth-shattering in my perspective, and that is, I've heard whispers that some of the private equity companies that have made major investments in some of these aggregators, they are quietly shopping the aggregators as a whole to other investors, often without the aggregator leadership team even being aware of this. And so the private equity folks, they want to protect their investments. And so if they can find someone who will buy the whole aggregator and all of its good and bad problems, just take it on, in some ways, that's a way for the PE to do some of its own rationalization of assets.
Wow. Who buys them? That's what comes to mind.
You've got some aggregators that are reasonably well run that still have cash. And if they've got good M&A teams that know how to pick over these portfolio companies of another aggregator and say, okay, here's 20 portfolio companies. We see that 5 of them are actually really good. Another 6 or 7 we can resurrect. The rest of them we don't want. Then they can value the business based on the assets that are worth keeping. And then they can still apply a discount on that. And if the private equity company that's looking to sell the portfolio company, if they're desperate enough and recognize that they don't have an easy path to solving this problem themselves, the aggregator who's in a good position may be able to buy another aggregator's portfolio companies for, I don't want to say pennies on the dollar, but for very steep discounts over what they might have bought if they had bought those companies one at a time.
No, I actually think that's good news if that happens, right? If they can revive any of these, nobody wants to see a business go under, right? Nobody wants to see a brand go under. I mean, the reality is the aggregators employ a lot of people.
Yep.
And I always like to see people win when they're trying hard. And I think I think there was the time of the money just running crazy and people not doing the due diligence. But I think, I don't know, it'd be great to see as many of these brands and people at these companies survive and keep moving on. And if that's underneath a different aggregator, then awesome. I haven't even thought about it from that perspective, but makes complete sense. But again, James gets back to like the kind of the thing that you called out originally was a lack of due diligence. And so the way this works out is these aggregators that have done a great job on their due diligence have to do an even better, just keep upping their game, because it's going to be even more complicated to dig into every single one of those brands. It's probably going to be a longer time frame, but that would be.
Well, it gets messy when the books for 20 different companies all get rolled together. How do you separate out costs and revenue for each brand so that you can then turn around and compartmentalize that and potentially position that for sale? That gets complicated. So you need folks that are really good at the M&A numbers.
Wow. No, it's awesome. Any other highlights or things you'd like to, as we kind of get to the end of this episode here, for the audience?
As I think about what does all this mean for CPG companies who might traditionally have been interested in buying brands that had strong Amazon channel presence. As much as aggregator businesses might be discounted, I suspect that for many CPG firms, their first priority is going to be looking for brands that aren't yet part of an aggregator portfolio. That is to say, brands that are looking to go to sale for the first time. Well-run companies where CPG M&A teams can go in and do their due diligence, decide whether these assets fit in with the existing portfolio that the CPG firms hold. I don't know that CPG is going to buy a lot of these aggregator businesses, again, because I think in many cases they're too small for CPG to be interested. And these brands don't come with large operational teams that can be brought in-house to help accelerate e-commerce or Amazon knowledge within the CPG companies. So it'll be interesting to see what happens, because I don't think CPG is ultimately going to be hurt or helped by what's happening with all this aggregator rationalization.
Awesome. Love it, my friend. Love it. As always, thanks for jumping on the podcast here and being so open to share your thoughts, ideas across the board. And, again, everybody, James Thompson, you can reach out to him on LinkedIn. It's a great resource for the network as a whole. And as we wrap this up, just want to say thanks again, James. Hope everybody enjoyed the episode today. If you did, it'd be great if you'd like it, if you subscribe and share it with a friend. With that, we're going to wrap this up. Looking forward to continuing our deep dive into digital strategy together. Thanks so much.
Thanks, Aaron.